Probal Sen, who tracks the energy space very closely at ICICI Securities. Probal, thanks so much for joining in. We'll come to earnings in just a bit, but let's address the hot news in the room in the last 24 hours, these sanctions and what they mean for oil marketing companies. So let's start with the OMCs first up. Just run us through your expectations, how you were expecting refining margins to shape up in Q2, and more importantly, what happens now if oil remains elevated and some of these refineries can't source Russian crude?
To answer your first question first, I think expectations are similar to what Sonal discussed earlier. Refining margins have been fairly healthy and are expected to increase by anywhere between $2 to $2.50 on an average for the OMCs on a sequential basis. Year on year, the number will be slightly higher because of a low base, and inventory is also expected to be favorable a little bit to that extent. And therefore, numbers for Q2 look fairly healthy on a YY basis. As far as the second part is concerned, what happens with respect to Russian crude? There have been multiple sanctions, there have been multiple moves by the EU in any case over the last year or so, which have not really had a material impact. I mean, they've increased the effective cost of procuring Russian crude, but the flows have not really stopped. I think the fear really is that if the flow itself gets stopped and you have to sort of shop around for alternative sources of crude, it would essentially increase the cost of procurement. Simple as that. Today, you have 25 to 30% of crude still coming through in our overall sourcing mix from Russia. And if you have to replace that with alternate sources, you lose out not only on the discount that you're getting on Russian, which is around $2 to $2.50, depending on who you ask, but you probably may have to also pay slightly higher to procure crude at short notice. So assuming that there's a $3 hit that you take on 30% of crude, simplistically speaking, it causes a $0.9 a barrel hit on your GRMs. What can offset it is the fact that diesel and ATF and gasoline spreads have actually improved quite a bit, at least in the beginning of this quarter. Even though benchmark margins remain subdued because of other products, for Indian refiners, the strength in diesel and ATF and gasoline is actually a fairly positive development if it sustains. So we'll really have to see and weigh. In terms of earnings impact, every $0.50 reduction in GRMs from whatever base you're looking at reduces your consolidated EPS by anywhere between 4.5% to 7.5% for the OMCs. For Reliance, the impact, while in absolute terms may be higher, but because of their consolidated nature, the impact would be in low single digits in terms of consolidated EBITDA.
Those are lots and lots of numbers, very detailed, and really gives us good context. Let me just repeat that for the benefit of our viewers. You're saying that a shift in the sourcing mix, if we say that we drop down to zero Russian crude and then move to alternate sources, then because we lose on the discount and the transportation cost goes up, so purely on the back of that, the hit could be $9. Right?
No, sorry, it's $0.9.
$0.9. Okay, $0.9. Okay, yeah, that's what I was wondering. Okay, that sounded like huge. $0.9. But you're saying that it should be more than offset by diesel and the rest of the crack. So net second half, what are you expecting on GRMs? Based on the assumption that we go down to almost nil Russian crude.
Yeah, I think as I said, it probably would remain similar to current trends. As I said, one thing would offset the other. So we continue to build in reasonably healthy margins. Reliance doesn't report GRMs explicitly, but the range is anywhere between $9 to $10 is what we are working with at this point of time. We see no reason to change it. And for OMCs, it is in the range of around $6 to $8. That is something that we will continue to live with at this point of time.
All right. Hi, Probal. Always good to hear your thoughts. What about the city gas distribution companies? What are the expectations from those names? And what do you like from the pack?
We continue to like MGL. I really think that the volume growth coming through in a fairly strong way, with the margins continuing to be, let's say, while they're not going to hit your record levels that they hit a couple of years ago, of 12, 13 rupees of gross margins. Or EBITDA margins rather, they are now looking at a more moderate margin environment, but the volume growth coming through, I think, continues to be a surprise for us, and the sustenance of that volume growth should lead to our performance. IGL also looks healthy to us right now. I think they are achieving slightly better volume growth, and with the moves that are happening on the zonal tariffs, as well as the news coming through of VAT reduction, their cost of cash should actually continue to reduce over the next few quarters. So MGL, IGL is the preferred pecking order right now.
And on Reliance itself, on the oil and gas side, what would the expectations be for the second half?
So I think the EBITDA run rate, should probably continue to be in the around 14.5 to 15,000 run rate. Again, there are several countervailing forces. Petchem margins at the margin are, a bit of a mixed bag, but they have improved a little bit. If I look at trends versus last year, refining margins, as I said, continue to look strong. But again, now with this crude cost coming through, you could probably have a little bit of a dampener for the second half. So on the whole, for the full year, we continue to believe somewhere between 55 to 60,000 crore of EBITDA is eminently doable for the OTC segment. And, of course, on an overall basis, we continue to believe that earnings growth will, on a consolidated basis for Reliance, should be in the range of around 13 to 14% for this year.
And GAIL, Probal, what to watch out for this quarter?
I think volume trends have been a little bit mixed. Power demand continues to be subdued, and therefore, overall demand has seen a little bit of a slowdown. But I think the guidance that has been given now of around 5 to 7 MMSCMD growth over last year, I think that should continue to be there. I think what is more of a important monitorable is what happens to trading margins, given the way that they have behaved. I think the trend has been a little bit more muted compared to last year. In terms of the quarterly run rate that has come down to somewhere around 1,400 crore a quarter. And I think that remains the key driver for earnings. And of course, as and when the tariff order comes in, that will remain the big trigger for this year, really, in terms of how the stock behaves.
All right, Probal, thanks a lot for joining in, giving us your thoughts. I think you were getting a couple of calls. The kids have their holiday season. I'm not sure whether it was them. Thanks a lot for joining in and giving us your quick input.